Tonight's hosts are, for example, me, who is Mathias Schulze. If you haven't heard about me, I'm at Day IT Management Consultant at ISG, doing working with clients in the field of digital workplace, new work, human work, and also the physical workplace recently, more and more. And at night, I'm also hosting meetups on FinTech, financial things, and also investing. And with me is also my fabulous co-host, Lena. Hello.
Hi, everyone. My name is Lena. Nice meeting all of you. I'm totally excited about tonight's session. As Mathias said, so many of you are joining and you're very welcome to discuss with us tonight's topic. My name, as I said, is Lena. I co-founded a fintech called Fino for the last 5 years and exited it mid of last year. And I'm happy to be your co-host of tonight.
Maybe introducing the theme of this evening is digital asset management. So it's everything around crypto, wealth or asset management, tokens, and so on. So why are we doing it? As you can see, the last meetup we had, or the first meetup we had in the sphere of crypto was end of 2017. As you can hear in the chart, we always do that when people are interested. Then we had in May 18, we had something about blockchain. And then we had nothing about crypto because nobody was interested. But now, as you can see on the chart, it's not a logarithmic chart. I think it's a linear one. You can see and people are interested again. And that's why we are talking about it, because we always do what people are interested in. And here you can see also that that crypto is maybe in the press and the media, but it's not so big. You know, real estate is much larger. Gold is much larger than crypto, because crypto you see at the right bottom is still very small, but we think it's here to stay. Why are we thinking it's here to stay? Or maybe first of all, having a look at the market cap. So the most important coins are still, if you talk about currencies, is BTC, and the most important altcoin is ETH. But what's also interesting is that you have more and more stable coins, that you have a kind of low volatility, not so much volatility store of value, but I think also Oliver will talk about it later on. And another thing why we think it's here to stay, crypto is gaining adoption, is that, of course, PayPal, for example, large companies like PayPal are implementing it in their products because they have been under pressure of the Square Cash app that has been implementing it a couple of years ago. And we have also support from institutional investors, like a hedge fund from Stanley Druckenmiller, who invested in Bitcoin additionally to gold, because you can make more returns. And then we have also some companies who are investing their capital in crypto, because they think it's a secure store of value, and they also have some more profits and gains compared to other asset classes like cash or bonds. Anyway, so let's hand it over to Oliver and Sebastian. Maybe a few words about them. Oliver and Sebastian are both serial founders, and they are both hosts of a podcast called, I think, Aus purem Interesse. It's a German podcast, and they dive slightly deep into the sphere of crypto. And and Oliver, I think he was also before Giant Swarm, which is a company in the space, in the field of Kubernetes, managed Kubernetes and microservices. He has been in EdTech like Legatos, which is something like Outbrain, I guess. And Sebastian is a founder of 9 Elements, which is a company who is building digital projects like the 7Mind app that you might have heard, some meditation app, and also have been developing before that some app called Watch Later that I have also used for a couple of months. So very good. You can share your screen if you want. It's time for the first talk to give you a brief update about applications and infrastructure projects in crypto that are very important. I'm going to stop sharing my screen if I'm able.
We actually don't have a screen to share. You can keep that one, or we can just turn it off so more people can see more people. Thank you, everybody, for being here. So glad you turn it off and more people see more people on this wonderful grid, and we can see what happens. Thanks for the introduction. So yes, Oliver Thylmann, one of the co-founders of Giant Swarm. In the normal life, I run websites like Adidas and the Telecom Speaker and admittedly a crypto exchange as a Kubernetes provider. So we manage Kubernetes clusters for the large ones out there. When we saw that chart, I started writing about Bitcoin in 2011 and still bought on that name thing that I forgot what the name was, the one that is now defunct and was started by the guy that also started Ripple. So I've been doing this for a long time. Sebastian, maybe a few words about yourself. Do you need to unmute yourself? You're still muted.
Zoom.
Yeah,
Yes,
Zoom.
Sebastian Deutsch. I'm the co-founder of 9 Elements, which is a software development agency. So we do software for money, but we helped a lot of startups to kick off, and in that sphere we also dug a little bit into the fintech space. And it's not only that we are building for clients. Sometimes we also being technical co-founders of startups and. Yeah, but this is so far. I got into the whole crypto scene. Actually, I must say I left out on the whole Bitcoin hype initially. So I was aware when like everyone went when it was already in mainstream media. But I was so hooked. So I dug into so what else is there, and then I found Ethereum, and we were like pretty much at minute 0 when Ethereum launched and helped pre-mining and help the ecosystem. We actually built a mining farm in the beginning, and from then on, it never got off me, and I always followed, even when it was not like in 2017 there was this big bubble, it popped. But the interesting projects, they came after that. There were people who were not there for the money, but for building substantial software and decentralizing stuff. So Oliver, where should we start?
Exactly. So we thought a bit that it's a different setting. Normally the podcast aus purem Interesse is in German because we felt like there are a few German podcasts, and we actually just started out of interest, and like Sebastian and me like talking to each other, and it more or less goes into the deep end. So we have comments like people. So I listened to it a second time with a lot of pauses in between to write stuff down. I really liked it. So to a certain extent, it's an education podcast. And we talk about stuff like fractional stable coins and deeper into Uniswap. And what we thought we'd do here is go a bit through last year. Like I'll go one by one. I take one and Sebastian takes one, just in terms of like what happened the last year. For those that didn't remember, that really is beyond just price, because I mean, yes, we can talk about price, but that's middle interesting. But what will project start? We'll take turn by turn, then we'll go a bit into the future and try to give you a few ideas of what is coming. If there are any questions in between, is there this raise your hand feature here? Otherwise, I can't really see the chat. Just
one comment on the questions. We will post also a Slido thingy where you can post your questions that we can answer in the end, but you can also interrupt if you
okay.
feel it's urgent.
I think Sebastian and me are fine with interrupting. We might use this thing as a podcast in the end, so just make sure you might be on the air again. I'll really start and just start with a simple one. I know I didn't say it's about price, but we'll start with where this started. So like everything dropped almost 90% in the last years. It was pretty much down, and we started the year with 7,200 in Bitcoin and 130 in Ether. We ended the year with 29,745. And we had stuff like 50% drops in between, and now have something like 7% of Bitcoin in the holdings of corporate treasuries, of real corporate buyers. So there's a large change on the money side, but especially on the Ethereum side, a large scale of that growth comes from just it really being used. And one of the large things is, for example, the distributed finance part, that you can build stuff, like you can build a bank and an exchange and lending and so on and so forth on crypto. And there was actually, for example, in its contracts, I mean, we have the first DAO, or the first distributed autonomous organization, which was years ago, actually failed because a bug in the contract, and they always said like code over agreements. And there was a flash loan system actually this year where there was a bug in the contract, and they could empty wallets through that by exploiting the bug in the contract and loaning stuff in real time. But I'll hand over maybe to another more like what broke or what interesting other things to Sebastian next.
Yeah. It was like in 2018, there was like 2018 was the year of the stable coins, because like when the big speculation bubble popped for crypto, people were thinking like, if Vitalik Buterin, who is the inventor of Ethereum, asked like, how many people have we unbanked? Like, how useful is that what we're doing actually? And he in the bottom line, he was like pretty frustrated where the whole ecosystem were, and say people are not using cryptocurrencies outside speculation because the volatility is so high. So stable coins got invented. In the beginning, it was centralized stable coins like Tether, where we will get back later to again, where the idea is that you have a cryptocurrency where every like dollar at the cryptocurrency, US dollar Tether, USDT, is backed by $1. And there's also a project from Circle, it's like USD dollar C. But these are actually centralized. So if some government decides to take them down, they just can. Like Circle is a US company, if it needs to be regulated. And there was this one guy who had the idea, what if we can build a decentralized stablecoin? And I'm going to post the link. The first one was MakerDAO. And it was a pretty interesting project where the basic idea is that you can take your Ether, you're going to lock it up in a smart contract, and you can take 2/3 of the value, you can take it outside in a new cryptocurrency, which they called DAI. And the DAI is also pegged to $1. And in order to make that work in a decentralized way, a lot of things have to come together. For example, if like the DAI that you're going to take out are like 2/3 of the value of the Ethereum that you're going to put in. So if the price of Ethereum drops for 1/3, you will come to a point where the DAI that you took out are actually under collateralized. So they are less worth. So the first thing that MakerDAO did is they created an army of bots, which they call liquidators, and they gonna sell these Ether on your behalf and liquidate them on the market in order to generate like fiat currencies, and then they're gonna like keep the DAI like stable for that one. So if someone is selling a lot of DAI and like driving the dollar price like below the peg, then they're like buying DAI, and if they like if it's above the peg, then they selling DAI and also trying to make some money on the arbitrage. And a lot of people said this won't work. Like wait until a crash will occur, and like a volatility of like 33% is nothing in crypto. And actually, MakerDAO survived
Black Thursday.
Yeah, it survived. Like Black Thursday is special because at that point something really bad happened. But initially it survived. So now the crypto space had its first decentralized stablecoin, and this is where it really took off. Why did it took off? Because locking up Ether inside MakerDAO and having DAI, they needed an instrument for people just to hold DAI, because like the system needed a reserve on DAI which they can use to do some arbitrage on the centralized exchanges. And in order to realize that, they actually paid the people who were staking DAI into the system, they paid them a fee. like a daily saving rate. This is what they called it. So you could put money inside the system, and you got out a pretty nice rent. Like it was at the beginning was like 8%, and people was like, okay, I gotta get some 8% somewhere. This is in these times of investing, it's like really high, and the risk is, sure, it's like crypto, it's like pretty risky, but it's not as risky as like holding Ethereum, because the currency was pegged. There were already 3 major, not really crashes, but MakerDAO was pretty stable at that time. And the daily saving rate that you actually got when you put in some DAI and staked it there, it was paid by the people who were like taking out the loan. So if they want to repay their loan, they have to pay an 8% stability fee. And all that variables in that community, like what is the stability fee, how much do you get for daily saving rate, that was also pretty novel, was actually driven by the community. It was not like a company or something, but you could actually participate in the project by buying a token which was called Maker, MKR. And the Maker token allows you to be part of the governance. So they created pages with proposals. Should we raise the DAI limit? Should we increase the daily saving rate? Should we decrease the stability fee? And people could vote with the Maker coins they have into how the project should evolve. So that was also something I've never seen before in that manner, so that it actually worked. And I was pretty amazed about that community. And yeah, from then on, the next cool project was like actually Uniswap, right? Do you want to think about Uniswap?
So you have the first guy that builds a stable coin, and then you have, in between came some like Compound, which was like, again, this credit stuff. People started earning stuff by staking coins somewhere. And Uniswap actually was started by a guy that was jobless and had no clue about code, and he started Uniswap. I think there are 11 people at the moment. They're just looking for 2 more if everybody's interested. Point is that they figured, can't we build an exchange like Coinbase on a contract and automate it and distribute it again, and like uncontrolled by a central authority? And so Uniswap is a decentralized exchange with liquidity providers. The interesting thing there again is how you earn money. So you can imagine that there actually on all the big exchanges, and just also for arbitrage, there are so-called liquidity providers. There are people that are providing liquidity. So if you go in and say, I want to exchange 100 euros to Bitcoin, somebody has to do that trade. And there are people that are evening it out and providing liquidity everywhere. On Uniswap, I can go and say, I will now go into an Ether DAI pool, for example, or Ether USDC pool, and give money into that. And I will provide liquidity on both sides. So I'll put in 10 Ether, which at the time are 1,000 euros. So it's 10,000 euros. On the other side, I put in 10,000 DAI, which is the same value, and I provide that pool. And there are a lot of people doing that. And Uniswap takes a 0.2% fee. So who's getting that 0.2% fee? The liquidity providers. There is a proposal again through a coin. There is a proposal again to make sure that sooner or later the Uniswap team also gets money, but for now it's the liquidity providers that get it. Now you can imagine, if you take a look at the stable coins, for example, the Tether is, I don't know, 20 billion worth and exchanges 60 billion a day. So if there's an exchange of like, if you have $20,000 in there and it's exchanged 3 times a day, then you make 0.6% a day, which a year is a lot of percentages. So you can really suddenly, there are Uniswap pools where you can make 100% whatever, and that actually makes sense because you're something that otherwise is only locked for bigger companies. And then Uniswap had a similar problem that that Ripple has, which we might go into later. That Uniswap had the problem. Now they want this community token and this uni also for voting and other things and providing returns and things and how to distribute them. And what they did, what really people loved, is they said, okay, everybody that did a trade before 1st of September 2020 will get 400 uni tokens. So they distributed uni tokens over the entire community and got the love of that decentralized community. So that got us the first really distributed exchange that now has a trading volume of hundreds of millions or billions. I don't know the exact number. Somebody can look it up. It's gigantic, especially for something that is just a contract and uncontrollable. And admittedly, there's a large, long tail of stuff that you shouldn't exchange over Uniswap.
Yeah. Maybe I chime in here. It's like Uniswap had another novel idea. It's like, centralized exchanges, they're going to run on an order book. So people are trying to sell stuff at a certain price. And the average of all the people who are selling stuff is going to make the price, which is called like a market maker. And Uniswap actually had a really novel idea. They had this idea. If you want to trade a pair, for example, Ether and DAI or Ether and US dollar T, you put the pools in like with a 50-50 percentage, and you take a mathematical function, which is actually a quadratic curve, and say, okay, if I'm gonna buy one of these, if I'm gonna buy Ether for DAI, I'm gonna move on that quadratic curve and make DAI more expensive because like I want Ether. And if someone wants to sell Ether, it moves back to the DAI. And the idea was to stay at the center point of that quadratic curve. And in the beginning, it was not 100% sure if this actually works out. So if they could manage to attract enough liquidity, if the whole like staying on this fixed equation on this quadratic curve, it was not clear that it worked out. But eventually, it worked out. And this is also why the community, all the people who were providing liquidity, all the people who have used Uniswap in the beginning, were rewarded with that uni tokens, with the free uni tokens. Maybe like these 400 uni tokens are currently like roughly about 3,000 euros. So it's not something which is like a, hey, if you invite someone to Coinbase, you get $10. It's like, hey, if you used Uniswap before, you get $3,000, which is definitely something.
The first guy I invited to Coinbase, I got 0.1 Bitcoin for.
Okay.
Yeah. And just to finish that part off, which recently happened, because it's interesting because of the coin distribution. Ripple was sued on 23rd of December of this year by the SEC in the US, and XRP dropped to a large extent, which is to a certain part because Ripple just owned the largest part of XRP and can do with it what they want. So there you have the problem that actually only a fraction of the XRP is out there, and the large parts belongs to Ripple, the company, and they can move markets. And they never told anybody if they sold something. And that's what the SEC doesn't like. So it's really against Ripple a lot more than XRP, but XRP being so tied to Ripple, that's actually why it fell. And we had another big thing that happened in last year. Maybe we can quickly get into. We have an entire episode on it. Ethereum 2 launched, and you actually started staking yourself, right?
Yes. Yeah. It's like we were like running a mining farm in the beginning from Ethereum. Like we stopped it at some point because, like in Germany, with the electricity costs, it does not make sense. But when Ethereum 2, they actually switched from a consensus algorithm. Like this is this mathematical riddle each miner has to solve in order to validate transactions, and they switch it from proof of work, where you have to solve that mathematical riddle, to proof of stake, where you actually put a lot of money in. Like the algorithm now works like this: there are transactions incoming from the network, and out of like 20,000 validators, randomly one is like elected to be the block proposer, which takes and which validates the transactions and says like these transactions are valid, they are correct. And then out of the 20,000 validators, another 64 validators are elected as well, who are like controlling if the first validator who proposed the block is right. And if he's not right, he will lose all the money that he staked. Like this is the basic idea of proof of stake. And the benefits are that you don't have to waste electricity on solving a random mathematical model. It also goes down, you know, like proof of work has got an arms race where you have to buy a lot of like heavy graphic cards machinery to make it work, or have to buy ASICs. And now like everyone can join in with a Raspberry Pi, and it is actually narrowed down to the economical incentive. Like you're being right and you're being honest, then you will get rewards and keep your money. If you try to cheat, then you will lose all your money. And but there was like, in order to make that work, there was a lot of stuff involved. Actually, there was a big proposal for Ethereum 2. It consists of multiple phases, and phase 0 has taken off this year in December. In order to make that work, there were like four competing Ethereum clients, validator clients. There's a new blockchain, the Beacon chain, that has kicked off. And we at 9 Elements thought it would be super fun to be a validator and to lock in some Ethereum and to be part of it, since we believe that like this transition will actually leverage the network into new heights. And like this is Ethereum from like phase 0, because like the whole decentralized finance thing with MakerDAO, Uniswap, Compound, it leads that we have a lot of transactions. Like the network at Ethereum, it's pretty clogged. It's at 99% usage right now, and gas prices are pretty high. It's like when you say cryptocurrencies are to unbanked people who are not banked yet, and you tell them in order to make a transaction, they have to pay like $20 in gas fees, that does not sound very cool. Yeah, this is not what the original vision was. But with Ethereum 2, there are several things in order. Like first thing is like this moving from proof of work to proof of stake, which is also resulting in a better performance and more transactions per second. But also they are planning a phase 1.5 where they're going to shard the network, where they're going to take that huge single blockchain and make it different shards, maybe for different projects. It's not, eventually it's not 100% specified, but they want to scale to around about like 2,000 transactions per second, which is something that you can definitely work with, where you can like say, even like, I don't know how much MasterCard or Visa has per second, but like 2,000 is something where enough volume is there to do a lot of applications, to create a lot of applications. Yeah.
So that kind of concludes a little bit our 2021, and maybe a few things to watch. 2020, maybe a few things to watch in 2020, because we really see that there's a lot of stuff that raised a lot of money. We have distributed exchanges, we have credit systems, there are people, there's with Frax and with others, there are now fractional stable coins that aren't totally collateralized. There's lots of interesting things out there. I'd like to mention two, for example. There's a company called Definity that is launching, that actually raised 102 million from Andreessen Horowitz over 3 years, like roughly 3 years ago. Definity is launching a hosting system. So they have tens, if not hundreds, of data centers that are totally separate. These data centers provide, like Docker containers, to put it simple, like place for containers. That can be a smart contract, that can be a container that can run stuff, that you can distribute everywhere, that will always run in multiple data centers. They're trying to build a distributed cloud that cannot be killed and is not controlled by them. Everything is run through contracts. Go to Definity and look at and look at how their economic system works, it's mind-boggling. You know, they recently had their launch like end of last year launch event, and they really thought this through in terms of, again, you having an ICP token that is the token that allows you to be able to vote on decisions of the network. You need the ICP token to get the token that buys you compute resources. So the ICP token will shrink in the amount of tokens that are there because they're exchanged and then burned. So they can't come back. You need to buy ICP and then burn them to get the other ones. You can lock them in a contract, and depending on how you lock them, the more return you earn, and the more votes you have, and the longer you lock them, and the longer they are locked, the more votes you get. So if you lock them for 3 years and keep them in there, and after 6 years, the amount of votes rise. So it's incentivizing being there for a long time. Lots of interesting things. Second one is actually Blockstack, something that started as one name years ago on AngelList. Blockstack is a distributed application system. You actually have a blockchain-based word processor, an Excel sheet and presentation thing, chatbots, task managers, lots and lots of different things. They just launched a few days ago Stacks. Stacks is their new blockchain that sits to a certain extent on top Bitcoin and provides smart contracts on top of Bitcoin and an option of stacking, not staking as they call it, just to invent a new name. And through that stacking, you can actually earn Bitcoin. So you can take your block stack and stack them, which provides, again, security for the network, and earn Bitcoin with it. So all of these things kind of just like, there is real stuff slowly but surely coming that is not just money. And that really allows you to do stuff. A lot of it is obviously still about like earning in this entire craze, but really things to do that, to automate tasks, to get things done, to launch applications, to be in control of your data. We obviously have stuff like IPFS and Filecoin and other things to store data. So there's really stuff coming that is way beyond just making money. And based on the projects you see out there, there's lots of stuff where you see that people really thought economically about this. And with a group of coins, you can build economic incentive systems that really work. And that's what makes this space so amazingly interesting, especially long term.
Yeah. For all those who want to see, like, these are, I call this infrastructure projects, but for all the people who want to look at the actually applications that are out there who are making money, should check out DeFi Pulse, where you can see like this MakerDAO, where sort of like MakerDAO is like a big lending platform or credit making platform, Aave, Compound, Uniswap, where you're going to see them and you're going to see how much money is actually inside there, and you can make up for your own if you want to be a part of this one, or if you want to go inside there. I have one very last topic that is, for me, it's like pretty interesting, and this is algorithmic stablecoins, like you actually mentioned Frex Finance, and for that one, I have to like get a little bit more basis. If you take the euro, this is going to be an elastic currency. Why it's elastic? The ECB can print money, and if you have like 1,000 euros in your bank and the ECB prints money, they actually got inflated, so, or diluted. And if you take Bitcoin, this is an inelastic, non-dilutable currency, because like there are 21 million, and if they're out, they're going to be out. And some guy thought, what if I create a currency that's going to be elastic, but it won't dilute? And like this is something that you can do in the real world.
Took me a bit of time to get that one.
Yeah,
we talked about it last podcast. Go.
Yeah, And like in real world, you can't do that, because if you have 100 euros in your pocket and the ECB prints money, you can't open your wallet and like suddenly out of magic, it's like 110 euros. But with cryptocurrencies and smart contracts, you can do that. It's like you can see how much wallets are holding which value. And if you're going to increase the supply, you can like benefit each holders and give them pro rata, the amount that you print. And make it non-dilutable. And people are actually using this to create stable coins, because they say like the people who had it in their pocket, they're actually probably going to sell it, and then the price drops. Or if they have like less of it and they need it, they're going to buy some, and this increases the price. The first of its kind was like Ampleforth, like as an experiment. And from there on like moved others, which is called like empty set dollar, and D-Base is another one. And yeah, and this is also a pretty interesting thing, because like if you think that through, for example, if Europe at some point will get a digital euro, and you think about like if the ECB prints some money, and you can actually give people who don't have much money, you can say like, so that you have like, for example, if you have 10,000 euros, you saved 10,000 euros, we're gonna give you something on that if we're gonna print money. And people who have a lot of money, like people who have like 10 millions in the because they're incredibly rich, you don't give them that much. So there's a lot of design opportunities in these rebasing mechanisms of these elastic and non-dilutable stable coins. And yeah.
And that's what makes this like perfect for like first question from Anke about like what will happen with Miss Helen not being a crypto fan in the US and stuff. That's what makes them afraid, you know? And that's what's that's what's so fascinating and mind-boggling. You can theoretically build an automated system that everybody has 500 euros at the beginning of the month in their pocket, independent on how much money they have in their pocket. And they can have a saving things next to it, but that has a limit. You can do a million things that wouldn't otherwise be possible. That makes governments very afraid. But I really like the saying of some of the VCs in the US, you can't stop tens of thousands of engineers inventing stuff. You know, especially with some of the stable coins, and like Uniswap is a contract. Like you can theoretically put the guys that invented it in jail, but that doesn't stop Uniswap.
This is like a fun fact. He actually tweeted about it. It's like, you can put me in jail, you can actually block the website, but actually 2/3 of the volume of Uniswap, which is 4 times the volume of Coinbase Pro, like it's billions of money, billions of euros each week. 2/3 of this volume is actually triggered by other smart contracts, and roughly about 140 other websites who are using this. Some of them even run on IPFS or on unstoppable domains.
Yeah, unstoppable domains, another example. You can get an unstoppable domain, which also already works in Opera as far as I know. Otherwise, you need a plugin. And the domain name is registered to your Ethereum wallet. So there's no central, for those that don't know DNS, like if you look for google.com, it asks who runs.com. It looks at a few servers that are in your browser fixed set in your computer's DNS system. .com goes there. They tell you Google go there, and they start looking. This will just go to Ethereum, and it's your name, and nobody can take that. Nobody can change it. There's no central authority. .com could turn off Google if they wanted to. So that's really the big change, and that's why I think they will, like, of course the US will try to regulate a few things like this. There is risk. I mean, at the moment you can make really nice amounts of money with shit coins and insider trading. You know, that's true. That is possible. Like if you know your way around code and can read stuff and know people and are very active on lots of different channels and communities and Discord and Telegram and so on and so forth, and build that up, you can do stuff that is sketchy is the wrong word, but you're amazingly early and can lose your shirt. Like if you know what you're doing, that's fine. And that's why we have rules that not everybody can invest in startups, because actually 90% of startups die, and that's how it's supposed to be. And hence you can lose your shirt, and hence you need to know what you do. You can't invest in one startup, doesn't work. So that's what you need to pay attention to. And that's also why there will be regulation. And there is know your customer. There are very few, like there's an exchange in, I don't know, North Korea that you can register on via VPN that doesn't require know your customer. I don't know. But a Coinbase, a Binance, is, if you really want to do something on a big exchange, you need to register with your passport and stuff.
There was one
big-
question.
yeah,
There's one question. Like, if you're a beginner and how
Yeah.
to start, I would like to answer that. Or do you? Weren't you
No,
finished?
go.
Okay. Like if you're a beginner, you should like check out like this wallet, Argent. It's a pretty cool wallet because it's an app. There's a company behind it, but actually everything is decentralized. So there's a smart contract who's like holding your accounts. It's not the company holding your accounts, it's a smart contract. And you can also allow your friends, you can invite them to be your guardian. So if you're going to lose your passphrase, they can help you to recover your private key. And it's super user-friendly and it's good to get into. And I can just recommend, like, go to Argent, get some crypto, get some DAI, get some $C, and then maybe install MetaMask. Like this is another project like which you can use in the browser, and do something on Uniswap. Try something, just try it out. So for legal reasons, this is not financial advice. Like the market has run crazy. Ethereum rallied 10 times since last year. And there's a risk, like if Yellen says like, we're going to regulate Bitcoin or Ethereum and we're going to forbid it, then probably you will lose all your money. It will be gone. And maybe out of these ashes, there will rise some new stuff. Like, I don't think that it will be possible because the public interest is actually too high. For example, Muchen, who said like that we're going to regulate Bitcoin, they started like a proposal which they wanted to get through before the Trump era ended, and they didn't manage to do it. They got an extension, and the new guy for the SEC, which is like more the regulation danger than the Treasury, is someone who actually knows crypto. He teaches it at I don't know if it's Harvard or Stanford, at one of these. And there's also some news that came out that the Treasury actually allowed banks to settle in stable coins and to use smart contracts to do that. They would not do it if they not see the potential of the technology. So
they don't care about the technology as much as that they see it as an opportunity. They need to care for protecting people. They need to care that we can't just all run rampant. And like at the moment, we can probably give you 3 links and you can create a coin and you can launch it on Coinbase and you can get 3 friends that create liquidity and people buy it and you make money. There's a bit more involved to really make money, but it's like it's not witchcraft, you know. We are moving into script kiddie territory where you can just copy something and then you have your coin and you just rename it and you're done. So that's the thing we need. That's the thing they need to watch out for, because there is actual value and they see that. Like there's a new company, Spark, coming out with a credit card. They're using the Lightning Network. Lightning Network is a network above Bitcoin. So Bitcoin is theoretically gold, as easiest thought process, and moving that is relatively hard. It's heavy, you know? So Lightning Network is built on top to move fractions of a Bitcoin without any fees. It's like you have 2 Bitcoin nodes or 2 Bitcoin wallets, and you need to create a channel between that, and they can transact left and right, and sooner or later they settle. But they settle way later. And only when they settle do they need to move back to the Bitcoin blockchain. And beforehand, it's just independent, which means you can move fractions of US dollars. If you look at SWIFT banking system, if you use SWIFT to move money from here to the US, it will through SWIFT, through different banks to really move that money somewhere else. And to move that money, it's really expensive, but they need to move that money because banks don't trust each other anymore after the first financial, like the last financial crisis. So they don't trust each other. So they don't open books and say, okay, I sent you $1,000, just put it on my credit. We'll settle that later. They need to settle it directly. They use SWIFT and they send it over, takes 3 days, is expensive. Then we had TransferWise. What TransferWise does is I want to send $1,000 to the US, and then they wait that another amount of people want to send $1,000 to Europe, and they send, okay, then it evens each other out and they pay out the money. Pretty simple. With Spark, they move the money. You have a credit card in euros, and you want to move it. I want to move it to somebody else in the US. They will take these $100, do a live exchange on their local exchange in Europe, then take that money on the Lightning Network, send it instantly without fees, exchange it in US dollars, and it's there. They moved money in a fraction of a second, really moving it without any fees. If that really works, they still have to launch. It's mind-boggling. Like that's what Ripple tried to do for years, but they needed banks to work with it. So that's the other one. We have another question here about Avalanche. I think there's lots of things out there. That's like Blockstack is another one for developers. Avalanche, from what I understand, is also trying to be like a platform for developers to do stuff. I'm not yet sure if we're that far along yet. I'd probably have to defer to Sebastian to really get that from a developer standpoint. From my multiple founder, angel, whatever standpoint, I'd say, dudes, we're still at a territory where each of these is very different and uses very different things. And I don't know if you can standardize it that much already. That's where I would be skeptical. Long term, it's a cool play if they have the bandwidth and the breadth to just last for 5 or 10 years. Lots of opportunities.
Oliver and Sebastian, any last remarks?
Shall I answer on the Avalanche thing or something else? Yeah, maybe for the Avalanche, it's like there's a lot of, I call them infrastructure projects, which aimed at developers, because like this is something like if you want to look at a coin or at a project, always look at it holistically. So what's the opportunity? What are they doing different? This is also something where I like, where they're doing a great job. Like, how is it different from Ethereum? How is it different? What it really does different? But just being different is not a succeeding factor anymore. Like, for example, for oracles, like there's been Chainlink, which is like the biggest oracle provider. There are a lot of oracles who are like also doing a decent job. None of them has catched like the numbers of integrations like Chainlink did. And this is something, if a project is able to build a successful community, and this is why I invite you, like, be more honest, to join Discords, to join Telegrams, talk with the people, get a feeling how active a community is. Do their getting started on your computer if you're able to do some coding, like getting a hello world, do something. If it feels good, then it's maybe worth something to invest in. But like the first time we invested in Ethereum was like, I don't know, 5-6 years ago. And it's paying off like right now, maybe.
Yeah.
So then you're not working anymore.
As last words, I say exactly like Sebastian said, do it to learn something. You might make money on the side. If you do it to make money, you will fail. I'm 99% sure. This thing will drop. This thing will be more volatile than your stomach can fathom. But if you're in that to learn something, which we were from the beginning, then go. You know, worst thing that can happen is you learn something.